Welcome to this weekly update. I'm Julia Lee, an equity strategist at Bell Direct. And 2018 is turning out to be a difficult year for most asset classes and markets. In particular, we've seen emerging markets coming under a fair bit of pressure. So I guess today we will be focusing in on strategy, especially near term as well as in 2019. But let's kick off by having a look at the material sector and Morgan Stanley. It's re-evaluated what it thinks of different metals and the prices of where they are headed. Their top pick is Mineral Resources, which they say is trading significantly below valuation, but they also like Iluka, Whitehaven Coal as well as Fortescue. For long-term prices, the biggest revisions that they've made have been focused on the bulk commodities, with thermal coal and iron ore gaining 16% and 21% respectively. But they are cautious gold equities. Spot gold prices should be in for a correction should trade-related concerns ease in Q1. Having a look now at the oil space and Citi. Citi has downgraded their forecast for oil. They're now forecasting $60 a barrel average price for this calendar year, and for 2019, $55 a barrel, which is down $13. They do maintain a neutral stance on the sector, but their preferred stock is Origin Energy, and that's based on deep value having emerged in the stock. They're neutral on Oil Search as well as Woodside Petroleum, given that they remain cautious on long-term LNG prices, and in the small cap space they prefer Cenex Energy over Beach Petroleum, although it is higher risk and a multi-year thesis. Of course, here domestically there are potential changes on the horizon for franking credits, and UBS having a look at the franking impact. Labor's proposed franking scale back makes near-term returns of excess franking credits attractive. Among the large caps, BHP and Rio Tinto have already announced off-market buybacks, and UBS analysis highlights that Woolworths and Wesfarmers are the most likely to surprise with off-market buybacks and capital returns in 2019. Macquarie analysts have done similar number crunching and analysis. They say that Woolworths, Rio Tinto and Commonwealth Bank are the most likely to undertake capital management in 2019, given the large franking balances in those companies. Having a look at Macquarie, and as in Jaws, they're asking the question, is it safe to go back into the water? There have been a number of positive signals coming through from China and Italy, which are tempting investors back. However, liquidity continues to drain and reflationary momentum is still weakening. It might all still turn on a dime, but risks into 2019 remain high. They say that there's an underlying heartbeat that tells investors whether the general direction towards a greater deflation or reflation story is happening. And in a world dominated by asset prices, there is a need to generate more liquidity and debt than economies require. Despite the recent relief, the direction remains disinflationary and the coast is not clear, according to Macquarie. And value, having a look at some of the canaries which are starting to cough and splutter. So this is in regards to early warning indicators and the deterioration in the Australian economy, with 9 canaries deteriorating. They have concern for the Australian economy, given the implications for earnings growth and the Australian market outlook from some of these canaries. The first canary being vehicle sales down 7.4% year on year. The second canary is home prices down 5.3% year on year, but weakness masked by a massive 45% decline in home selling at auction. Housing finance is down 27% for investors and 14% for owner-occupiers. Number 4, money supply is at a 26-year low, with growth of just 1.9% year on year. Then now business confidence has fallen to below average levels. Number 6 is drought and farm GDP, which is down 8.4% year on year. ANZ job ads down 1.2% since January, and the eighth one is Newspoll, pointing to a landslide win by the Australian Labor Party, which points to significant policy change. And number 9, China tourist arrivals have slowed to just 1% year on year. This means that they remain underweight domestically focused sectors, particularly retail, media, housing related, as well as the banks. Next week will be the last big week of 2018. After that, we'll see holiday volumes on the Australian market, as it's dominated by some of those public holidays and most of the market being on holidays. But next week, we still have some pretty big AGMs. In fact, 2 of the big banks with their AGMs on Wednesday will be watching ANZ, as well as NAB. Orica also having its AGM on the Wednesday, and on the Thursday we'll hear from Dulux as well as Incitec Pivot. But of course, the big event that markets will be watching is the FOMC meeting on the 19th of December, where the markets have priced in another rate hike in the US. The key is going to be the dot plots and whether the Federal Reserve is going to be as aggressive about its outlook for rate hikes in 2019. If we see a winding back of rate hike expectations, that could set the stage for a Santa rally into year end. This is the last weekly update of 2018, so wish you all the best, a very Merry Christmas, and I hope your portfolio does well in 2019. See you next year.